Our next guest says the market has shown resilience in February with a broadening out from those big tech sectors into other names. Let's find out more on his views on the market. Joining us from Flower Mound, Texas, is Glen Smith, Chief Investment Officer at GDS Wealth Management. Glen, thanks a lot for joining us. Markets are up so far this year. They've sort of bumped along sideways in February, but there have been lots of concerning economic headlines to be sure. What's your take on these markets right now?
We're really excited about the market right now. Finally, the market started to broaden out. It's not just the technology sector. We have consumer staples, we have financials, we have energy that are all outperforming technology right now. Interest rates are still at 4.5%. They might creep up a bit to 5%, but historically that's still low. That's still robust enough to have a really strong economy. Labor force is very strong. We might have a few headwinds with tariffs affecting inflation going forward, but overall, this is a very strong economy. And as investors, we're just excited that it's not just a technology stock leading the way.
Why has there not been more disappointment among investors at the outlook on the Fed, which is now expected to cut rates only once this year?
I think it's because right now we have such a strong economy, so you can kind of understand why we wouldn't raise rates at this moment. And in terms of inflation, PCE numbers will come out next week. We think those are going to trend down a bit. And we think this economy is strong enough and resilient enough to maintain rates where they are right now. You still have valuations and pockets of the market extremely attractive. So while parts of it, you could argue, are getting a bit frothy, there's still a ton of opportunities in different sectors out there.
One of the big events next week is the earnings release from NVIDIA. Let's say theoretically NVIDIA tops expectations. What does that do to the broadening out that we're seeing in the market away from the NVIDIA style stocks to other stocks?
We saw a 20% drop recently for NVIDIA with the DeepSeek recently. That was a lot of potentially misinformation in terms of the valuation that DeepSeek paid for that technology, and did they or did they not have NVIDIA chips. So we think that was just a hiccup. NVIDIA, if they beat earnings, we think that's going to catapult them higher. That being said, you want to be very careful at these valuations. Technology stocks are a little bit expensive in general, so you want to pick pockets that make sense. If you're an investor and you don't want NVIDIA, you might want to consider a small portion, but if you've been in it the last few years and you're up significantly, you might want to trim down the positions and take advantage of it if it does pop.
How much mega cap tech exposure are you advising your clients to include in their portfolios right now?
So for our investors, typically we're trying to be no more than about 1% to 2% in any one stock, whereas the S&P Magnificent 7, you're looking at almost about a third of the S&P 500. So 1% to 2% is typically what we feel comfortable with. You might give up some gain if that stock takes off on a tear, but on the flip side, we think it's almost more important not to lose money on the downside in any type of significant pullback. Some of these stocks have just been on a tear lately.
Okay, let's talk about some lesser known stocks, and you like these stocks. The first one's Monolithic Power Systems, a company that designs and develops semiconductors.
That's right. A lot of times people lump semiconductors all in one bucket. What's unique about them is they create a chip to make products more energy efficient, whether it's your home devices, your refrigerator, your automobile, your smartphone. And this is very unique. We think potentially is somewhat resilient to even a weaker economy, as opposed to a semiconductor and an NVIDIA, which are primarily used for GPUs. They do have competitors. Monolithic Power Systems does have a major competitor. That would be Texas Instruments. But we think they're growing so quickly lately, and I'm not just saying that because the performance year to date and over the last 5 years has beaten Texas Instruments, but they're just they're smaller, so it allows them to grow much quicker. And we think this isn't going to slow down anytime soon. It has a 19 price earnings ratio. It has a bit of a dividend, and it's kind of the David versus Goliath story.
Another one you like is Hewlett Packard. A lot of people would consider it a tech name of the past, but you like it right now.
Hewlett Packard Enterprises. So it spun off from Hewlett Packard. It partnered up with NVIDIA last year, which is a huge deal for them and for NVIDIA. Without Hewlett Packard Enterprises, NVIDIA suffers to create the GPUs. They partner with them. In addition to that, Hewlett-Packard Enterprises is invested in the cloud. It also has a bit of a dividend, PE ratio of 11. I mean, compare that to any tech stock out there, and it's extremely attractive.
Okay, and let's finish with a stock that many consider to be the flagship of the Wall Street money center banks, JP Morgan Chase.
Yes, JP Morgan Chase has been one of our favorite for years now. It's up, even though it's up significantly, up over 50% over the last 12 months. We think it has room to grow. Where the interest rates are, even right now, net interest margins are record-breaking for them. If interest rates come down a bit, mergers and acquisitions should pick up. We think they're in a sweet spot. Jamie Dimon's been doing an amazing job. We don't think that's going to change anytime soon, and especially with these elevated interest rates, which we think are going to remain somewhat flat, at least until Q3 or Q4 of this year, is going to just be even better for their earnings.
Any guesses on how much longer Jamie Dimon will be in the top job at JP Morgan Chase?
I would say 3 to 5 years based on the last conference call he had.
Glen, thank you for this conversation. Glen Smith is Chief Investment Officer at GDS Wealth Management. He joined us from Texas.